Hi and welcome to our tutorial on compounding. As private investors, we are constantly bombarded with market news, stock tips, and complex financial instruments. But today we're going to strip away the noise and focus on the single most powerful engine of wealth creation available to us, which is compounding. Think of your investment journey not as a race, but as a snowball. At the top of the hill, the snowball is small, and as you roll it gathers a few flakes. But as it rolls down the hill for longer and longer, it grows exponentially until it becomes a force of nature. Today we're going to look at how to build that hill and how to optimize that snowball and how to avoid the hidden traps that melt away your progress. Before we dive into the data, let's establish a foundational truth. Many people mistake investing for a game of guessing the next big tech stock or perfectly timing the market. It isn't that. True long-term wealth building relies on structural maths. Albert Einstein famously called compounding the eighth wonder of the world. Why? Because it behaves in a way that human intuition struggles to grasp. Our brains think linearly. 1 plus 1 equals 2, 2 plus 1 equals 3, but compounding behaves exponentially. It is a slow burn that triggers an avalanche of growth. So let's look at the mechanical difference between how most people view returns versus how compounding actually operates. To master compounding, you must understand the stark divergence between simple returns and compounded returns. Imagine you buy a physical asset, like a rental property. If you take the rental money every month and spend it on holidays, you are earning simple returns. Your principal, the house, stays the same and your earnings are linear. Compounded returns require a fundamental shift in behaviour. Instead of spending that rent, you use it to buy a fraction of another property. And now in the next period, you are earning rent from the first property plus rent from the fractional property. You are earning returns on returns. In the equity markets, this means taking every dividend, every coupon payment, every capital gains and immediately turning it back into the market to purchase more shares. You deliberately expand your army of income-producing assets. So let's have a look at a real example here. Suppose you invest €10,000 today and we achieve an annual average market return each year of 10%. So look at the orange dashed line on the chart, and this represents the simple non-compounded return, the path where you skim your 10% profit out of the account every year to spend. Every year you make exactly €1,000, and after 20 years your portfolio has grown linearly to €30,000. A decent return, but nothing life-changing. Now look at the solid green line. This is the compounding pathway. So in year one you are making the same €1,000. But instead of touching it, you leave it in, and in year two, you are earning 10% of €11,000, which yields €1,100. So by year 20, that same €10,000 invested has ballooned to €67,275. Notice the shape of the green line is not a straight line, it's a hockey stick. The curve is the visual representation of your money doing the heavy lifting for you. If we look at the spreadsheet data behind this chart, a vital psychological lesson emerges for private investors. Look at year 5, the compounded portfolio is at €16,105, while the simple portfolio is at €15,000. The difference is only 1,100. At this stage, many investors lose patience. They think, I've sacrificed, I've left my money alone for 5 years and I'm barely ahead. This is where amateur investors abandon their strategy. But look at what happens between years 10 and 20. By year 10, the gap is roughly 6,000. By year 20, the gap has exploded to over 37,275. More than half of your total wealth in a 20-year timeline is generated in the final few years. So compounding rewards the disciplined, back-heavy investor. The real magic happens when you give the maths enough time to run. Let's look at another example. And this just proves the point that time is a far more powerful variable than capital. So if we look at this example between Susan and David, Susan starts investing $5,000 a year at the age of 25. She does this for just 10 years and then she stops at the age of 35 and never adds another penny. She leaves it to compound, and David starts at age 35, exactly when Susan stopped, and he invests 5,000 a year every year for 30 years until he retires age 65. So who ends up with the most money? Well, Susan does by a massive margin, despite putting in only 1/3 of the principal that David did. And why is this? Because her money had an extra 10 years head start to quietly multiply. So as private investors, your absolute greatest asset isn't your brilliant stock picking, it's the amount of time you give your portfolio to compound. So to construct an unshakable compounding engine, you must align these three distinct pillars: time, rate of return, and discipline. So we've established that time is the engine of this principle here. And next, the rate of return. So while 1 or 2% difference in fees or performance seems negligible over 1 year, over a 30-year time horizon, it can translate to hundreds of thousands of euros lost. So while we must seek high-quality growth-orientated assets, we have to be very strict on the amount of fees that we pay in order to minimize costs. And our third pillar is discipline. So compounding is a very fragile process, and every time you panic sell during a market downturn or withdraw cash from your portfolio to buy something, you effectively chop down your snowball. You reset the exponential curve back to year one. So true compounding requires the emotional fortitude to leave the machine completely alone. Now, many investors consider compounding their money safely in a high-yield savings account, but this really doesn't provide the compounding that we're talking about here. So a cash saving account will offer compound interest, but they only have one small engine, and the interest rate provided by the bank, which rarely outpaces inflation. So market equity investments, however, possess what we would call dual growth engines. First, you have the capital growth, the underlying value of the business or index that you've invested in increases as the global economy expands. But secondly, you can, well, in many cases, you can have dividend income. So when a company pays you a dividend and you have it automated to buy more fractions of that stock, you are multiplying your share count. So the next quarter you get a larger dividend payout, which buys even more shares. So this dual engine feedback loop is what supercharges wealth far beyond what traditional banking products can offer. So how do you translate this theory into practical everyday roadmap? So first thing to do is to implement a DRIP. So this is a dividend reinvestment plan. So ensure your brokerage account is set to automatically reinvest dividends rather than letting them sit as idle cash. And secondly, automate your deposits. Don't try to time the market. By setting up an automatic transfer the day you get paid, you engage in a dollar cost averaging process. You buy fewer shares when prices are high and more shares when prices are low. Third, you diversify broad scale. The enemy of compounding is catastrophic loss, and if you put all your money into one stock and it goes to zero, well, compounding can't save you there. By using broad ETFs or mutual funds, you protect your portfolio's momentum, ensuring the machine never stops running. So a good, broadly diversified portfolio is what you need. And finally, we'll revisit Albert Einstein's quote that we used at the start here, where he said compounding is the eighth wonder of the world. But as part of that quote, he also said, "He who understands it earns it, and he who doesn't pays it." So basically what he's saying is, if you're not earning compound interest on your assets, you're almost certainly paying compound interest on consumer debt or losing purchasing power to compound inflation. And in the modern economic landscape, staying neutral really isn't an option. So you're either riding a wave of exponential growth through compounding, or you're being crushed underneath it, also through compounding. So my final point on this is to talk about the delay penalty. So looking back at our primary example, by waiting just 10 years to invest that 10,000 cost an investor 37,000 in pure profit. This price was the price of hesitation. And many private investors say that they are waiting for the market to drop or they're waiting to have more money saved. And the maths really shows us that time in the market is almost always better than timing the market. So the cost of waiting for the perfect entry point is vastly higher than the risk of entering the market today.